Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm going solo again just to talk about some of the red hot growth stocks and whether or not you should buy them here at their highs or you should wait. This is kind of a key theme we've been discussing a lot on the podcast the last couple of months because a lot of these stocks just keep on running. But not all, but a lot of them have. And I'm kind of staying away from the AI story here because some of the AI stocks have actually retreated off of their earlier in the year highs and have decided to take a break. So that's a little bit easier maybe to jump in on some of those at the moment because they are breaking down off of those highs. But these 5 stocks that I'm going to talk about today are still running, still hitting some new highs. And so should you get in when there's this kind of incredible momentum? Now, some of my Zacks colleagues, especially Dave Bartosiak in particular, have always told me momentum begets more momentum. And so once you get that upward, rally going, it is hard to see it slowing down. Obviously, at some point it will. We've seen that already with the NVIDIAs of the world. But for now, these stocks have the red hot momentum. And that can run for quite some time. So I'm going to take a look at some of these stocks. They're all, let me look. Do I have any tech? I have one tech name in there. But otherwise, they're in other areas that you may or may not realize are just as hot as the AI or even the other growth tech stocks. And you may not be really noticing that some of the tech stocks have actually really gone nowhere this year. Some that were red hot or that sold off in 2022, got a little bit of boost in 2023, but then really still haven't regained their prior form. A lot of those are, some of the Cathie Wood type stocks or the PayPals and Squares. I've talked about some of them on the Value Investor podcast because there might be some value with some of those stocks now. But these are in areas that maybe you're not even looking or considering because you've been so caught up in what's going on with tech. So let's just dive right in. Some of these I have discussed on prior episodes, but I wanted to take a look again because they're still red hot. And I know many of you keep asking me about some of these stocks and whether or not you should wait on the sidelines. So let's discuss it and look at the fundamentals and the charts and try to figure out, is this a good time to still jump in on some of these? Or should you wait for some kind of breakdown, pullback, sell-off, whatever you want to call it in some of these names? Okay, so the first one I have discussed before on the show, but I wanted to talk about it again because it's reported earnings. They were good again, and the stock is still climbing. So it's Cava Group, CAVA is the ticker, and Cava is restaurant chain. It is a new to the stock market or relatively new IPO. It's considered the Chipotle of Mediterranean food. So that's always a compliment. Anything that's the next Chipotle is something I want to look at. And like I said, their last earnings report, where the stock was already priced for perfection, they actually did hit on all cylinders in that report. And so the stock has gone higher. So as you can see, it is a Zacks number 1 rank. So it is a strong buy here. It's got the F for value though, because this is definitely a growth stock and not a value. Scrolling down, it's trading at 258 times, but people are buying it on the growth in the future as they roll out more of these restaurants. It's a fairly small chain right now. So this is where people like to get in on restaurants when they're kind of just beginning to roll out the national story. So that is the case with Cava. Now let's look at the detailed estimates because that's what I always like to look at. And earnings, we see earnings going to be up 61% this year, 33% next year. This is the big time growth. look at sales up here. This is the expansion as well. 23 or almost 24% for this year and another 20% next year. This is why as growth investors, we really love this stock because for right now, they're really just crushing it on the rollout here. Earnings up. It's got the Zacks number 1 rank. 7 or higher after that last earnings report for this year and for next year. And then let's take a look at the price to consensus charts over there on the left-hand side. You can click on that. This is my favorite chart on Zacks because it really does kind of just show where the stock is in relations to the earnings estimates. And this is kind of a condensed chart because it did go IPO last year, but up and to the right, analysts having to keep raising on these earnings estimates because they've been a little too conservative. And this growth is, for now, very real with Cava. So it's got a great growth story. It is hitting these new highs. So year to date, it's up 106%. But the chart looks good on the earnings side, plus the sales growth side. So I'm still liking this as a growth stock, but you obviously are not getting it cheap at all on a PE basis. But nobody cares about cheapness with a newer restaurant chain that is red hot. So that's Cava Group, CAVA, still got that momentum. Okay, then we're going to look at another chart. Let me see. Let's just look at the chart on this one because the chart is very similar to what we just saw with Cava. It's Abercrombie and Fitch. I did this as a top stock pick of the week this week here at Zacks. And I also showed this chart, but up and to the right, this is not a new IPO. It's been around for forever, it seems. It was a hot brand a decade ago, but it's turned itself around. It's become another hot brand with Gen Zs this time. They weren't in on the scene when it was last hot. That would have been Gen X and millennials, actually. Then it's turned it around. So the Gen Zs are now in love with Abercrombie and Fitch. They just had a great earnings quarter as well. And they saw same-store sales comps up 21%. Now, any retailer that's doing double digits, I salute because that's not easy. Remember, same-store sales means this is what it's growing year over year. And it's that same exact store. So that's not easy to do, to grow the sales at that one store, 10% compared to last year. You better have a strong brand, strong product, the consumer really spending. It takes a lot. And to do it for, year over year over year is even harder. But right now we're just concerned about Abercrombie doing it for 1 year, and they did 21%. So that's really impressive. You can see it here on the chart. And, fans have been buying up this stock. It's up 107% year to date. That's just year to date. That's not off the 2023 lows. Fiscal 2025, the earnings expect to be up 47%. So they actually are doing the business is performing how you want a growth stock to perform, a growth business. 926 is what's expected versus 628 last year. This one's actually a lot cheaper than Cava with a PE of just 20. So the earnings are rising in addition to the stock rising. So the PE hasn't gone too crazy yet. It's not dirt cheap by any means, but it's in the respectable range for a company growing its earnings 47%. But can it keep doing it? That's always my concern with retail, but certain retail brands can stay hot for much longer than you think. And this one starting on the hot cycle right about now. So we'll see, but it's looking good. And they did, like Cava, they did bring their best game in the last quarter. So they were priced for perfection going into the earnings, and they actually succeeded in meeting those expectations. So Abercrombie and Fitch, ticker ANF. Okay, then we're going to switch over. I'm just going to stay on the price and consensus chart because, again, it's my favorite charts, and this tells a lot of the story. So we're going to talk about Eli Lilly again. It's been a little while since we talked about it. It's kind of gone quiet amongst the chatter while the AI is still getting all the play. But should AI be getting all the play? Look at this chart. Eli Lilly busting out to new all-time highs once again here in 2024. They are just in the news, not for any weight loss drug, but for their Alzheimer's drug. That is also lighting a fire under this company. Year to date, the shares are now up 47.5%, even though I know I talked about it on the show a couple months ago, wondering, should you buy now? Well, I guess you should have because it's still breaking out. And look at this earnings growth. This is kind of rare to see on a big drug stock, this kind of growth. So this year, 2024, earnings expected to be up 115%. When have we seen that in a long time for a drug stock? That is also rare. That does mean you've had some kind of breakthrough in some hot area to literally see that kind of growth in earnings. And it's 1361 versus 632. So this stock isn't cheap. It hasn't been cheap for a while, but you're buying those earnings at 63 times now. But maybe 115% earnings growth is worth it. Isn't that better than NVIDIA? That's even better than NVIDIA this year. But this stock, despite hitting these all-time highs, is not really getting much play. Maybe because it's over $800 now. So that basically takes out a lot of us mom and pop investors. We can't really trade it the same way because of the price. But I'm also wondering whether or not they might split this stock like NVIDIA just did and Chipotle is about to do to make it a little easier for it to be traded for, mom and pop investors like ourselves to buy shares and also for its own employees to maybe buy and sell shares. So that's something to watch going forward. I have no idea if that will be in the cards, but that could be why it's just not showing up as much on the chat boards and things, but it's red hot. The earnings look terrific. So if you're looking for a momentum play that is truly a growth play, this too is crushing it on the actual fundamentals, then Eli Lilly should be on your short list. Ticker L as in Larry, L as in Larry, Y, LLY. Okay, then we're going to talk about the one tech stock that I said I did bring. This is on cybersecurity. So a little bit different than, an AI play. It's not, it's talked about quite a bit. So it's CrowdStrike, ticker CRWD. Oh, I like a lot of these stocks right here. This is one that is busting out again to all-time highs. You can see on the chart, year to date, it's up 48.4% now. Also has a very pretty up and to the right earnings growth picture, very consistent earnings growth going on. Earnings expect to be up another 28.8% this year. We love that as growth investors to $3.98 versus $3.09. PE of 94. So you're not getting it cheap either. But again, we don't care. We're looking for the growth stocks with the momentum, with the hotness, with the massive earnings growth. And this is a very pretty price and consensus chart. So I'm liking this. And this is the kind of growth chart you want to see as a growth investor. Now, I did notice this when I was preparing for this podcast. It is a Zacks number 5 strong sell. And we're going to take a look at the detailed earnings estimates because I was like, how could that be with this kind of chart? Is there like one analyst out there who's lowered, everybody else is raised, but he's lowered in the last, week or something, and that's putting it down? But look at 2025. This is fiscal 2025. No earnings cuts, 13 increases in the last 7 days. But over here in fiscal 2026, there are 2 cuts, but 10 increases. So the agreement is on the increases even for next year. But I'm thinking it's got to be these 2 estimate cuts here, possibly, that are getting the number 5. Either way, I don't think it'll stay number 5 for very long, literally even just like a day or two. before this moves higher in some capacity. They did have to adjust here the fourth quarter. 6 are down, 5 are up. So they have been adjusting. And, we're still seeing the good earnings growth for next year. So 398 expected for this fiscal year, 484 for next year, 21% earnings growth. But that isn't really slowing down the stock. That it's slowing a bit from this year. It's still up the nice double digits and up over 20%. So these shares, again, up 48.4% year to date to new all-time highs. Not cheap by any means, but, CrowdStrike, it's been bringing the goods for the last couple of years as well, as you could see on that price of consensus chart. So still really liking these types of stocks here in 2024. I would be looking for any kind of pullback on any of these that we're talking about, but the fundamentals are still there to dive in. It's very difficult to dive in when the stock is at or near all-time highs. But occasionally somebody has the guts, even an insider sometimes has the guts because they just feel like they must own the stock here and that it is going to go higher. So they're buying in anyways. So that's something you have to weigh as an investor, but also remember every stock does have timeouts. They all have pullbacks. That's normal and healthy. And eventually these 5 stocks will as well. But momentum begets more momentum, as Dave Bartosiak always tells me. So right now, these are red hot momentum stocks. Okay, let's talk about the 5th stock. I've talked about this one before too. It's usually one of my go-to stocks when I'm talking about red hot stocks. And I haven't looked at it for a couple of weeks. And I was wondering, is it still up there? Is it still doing what it used to be doing? And it is Deckers. They own UGG and Hoka. So their shoes, that is still red hot. I'm bringing up the price consensus chart. I looked at this. I was like, okay, they still are breaking out. I'm not going to go into the saga like I do every time about how I thought about buying it in 2022, but just didn't for the value investor. And now I have regrets. But should I be getting in now or should I wait? It did have a pullback earlier this year here in 2024 before the recent earnings. And now it's busted out to yet another new high. Year to date up 55.6%. It is a little bit off those highs. So it is having a little bit of timeout here. PE is at 34. So that's not, sky high like some of the others we've just been talking about, but it's not a value either. But I'm buying this for the growth. The growth component is there. Fiscal 2025, though, earnings expected to be up only 4.9% to $30.59 versus $29.16. Fiscal 2026 up 12.3% to $34.37. So the double-digit growth is expected to return, but it's just been so red hot that the analysts and maybe even the company themselves are saying like, we don't want to get ahead of ourselves. Hoka is still selling well, but, it's been selling well for several years now, and we might see some kind of slowdown, especially if the consumer starts to pull back. But the good news is for Deckers, shoes usually perform well in slowdown periods because the prices aren't quite as crazy as some other items might be that you might want to buy new to like refresh your wardrobe or your look. So you might bypass the handbag or the expensive jewelry or even the clothes part, but you will buy the shoes, even the pricier ones that are Hoka or Uggs. So I like the shoe retailers, even in some kind of bigger global slowdown. But that also means we probably will see a bit of a retreat in the earnings and the stock if that happens. But for now, it's not really happening still. We did have that pullback earlier in the year. So maybe stay on the sidelines, wait for a little bit more pullback than what's happening right now. But Deckers still has the growth. It's still got the brand. And as I mentioned earlier with Abercrombie, once these retailers get the strong brand and the loyalty, it can stick around for pretty many years before maybe it goes out of trend or just something happens with the brand. And so Deckers got the Hoka, the hotness of the Hoka, and it's able to build on that with the Uggs. And that's a pretty powerful combination that they have with just those two brands. It's pretty rare to build $1 billion footwear brand like they did with Uggs and then build a second one like they're doing with Hoka. So I have to hats off to Deckers management. I've always loved their management and they are crushing it right now. So trading at 34 times, not sky high, but not super cheap, but we're buying that growth. So that's Deckers Outdoors again, DECK. So those are the 5 stocks that remain red hot outside of AI. It's not a totally AI story out there right now, but the question is, do I buy these? I've talked about them just months ago. We had kind of the same podcast going on and the shares have gone higher still. But if you're a growth investor, you got to like what you see on all of these charts because it's up and to the right for those earnings. And everything except Deckers has double-digit earnings growth expected. So that's what I want. I want to get in while the companies are building out their brands and their businesses. And that's what you can do right here with these 5 stocks. So let me repeat the 5 stocks again. There's Cava Group. It is one of the hottest of the restaurant chains, but there's several others that are also still hot on restaurants. But Cava is one of the newer ones. Will it maintain this momentum? We don't know. But the ticker there is C as in Charles, A as in Adam, V as in Victor, A as in Adam. Cava, CAVA. Then we had Abercrombie and Fitch rising up from the dead, back again on trend. Ticker A as in Adam, N as in Nancy, F as in Frank, ANF. Eli Lilly still out there with its weight loss drugs, but now also Alzheimer's. Ticker L as in Larry, L as in Larry, Y, LLY. Then CrowdStrike, still with the momentum. Several years now it's had this momentum. Ticker C as in Charles, R as in Robert, W, D, CRWD. And then we finish it up with Deckers because it still keeps running as well. And it's got powerful brands as well. Ticker D as in David, E as in Edward, C as in Charles, K as in Kathy, DECK. And as always, I'm looking to bring you the hottest stocks I can. I brought you some old economy stocks last week. Not too many of you as inspired by the old economy, but they're breaking out too. Some of these, I guess, are restaurants old economy. I guess we could call them that. And retail certainly is. That's one of the oldest industries in the world, obviously. But some of those old economy stocks really busting out. And so are these. So I'm bringing you as many hot stocks as I can. And if we do get some kind of more significant pullback in the overall markets, I'll be looking for deals. So you don't want to miss a single episode of The Market Edge. Every week, we're bringing you stock picks here and stock ideas. So get us on Apple, get us on Amazon Music. You can get us on Spotify. You can also get us on the video podcast, as always, on YouTube. Go to Zacks.com/YouTube, but be sure to get us somewhere. And I'll see you again next week with some more stocks.